What's up? It's Rowan here from Art of Smart Education with another weekly HSC Economic Stats update. Now, in this episode, we're going to be unpacking the impact of the recent Stage 3 tax cuts on inflation. We highlighted in previous episodes that it may create some inflationary pressure, and certainly the analysts indicated it would. There's now some data coming out that suggests it's not. We're also going to look at some new surprising data on the US economy, the fact that it's faltering, and what that therefore means for the global economy, and of course how the Chinese economy is also slowing and its impact on Australia, iron ore prices, and the federal budget. For those of you that's the first time dialing in, every week I summarise the key headlines from around the domestic and global economy, giving you the key stats and analysis you need to unlock that Band 6 in HSC Economics. So let's dive right in and take a look here. So this is a fantastic piece of analysis that was done by Westpac. The assumption was that the Stage 3 tax cuts would put more disposable income into households' pockets. Therefore, that would lead to greater levels of consumption, driving demand pull inflation. Now, ultimately, what has happened is that the Westpac economists, looking at lots of anonymous data, has identified that on average there was a $220 boost in post-tax income to people through to July, including other forms of income due to government subsidies, electricity cost relief, etc. There was a further 860. Okay, now. As a result, more money sloshing around the economy, risk of inflationary pressure. Now, the great news is that 70% of this overall extra income has flowed into savings with no evidence of extra spending in any particular age group. So the government had said, when they launched the budget that, they were not going to create inflationary pressure. It was always going to be about, improving the cost of living and really dialing out inflation. But the criticism has been from many quarters that the budget was inherently inflationary. Now, we're still very early days in, right? Like we're literally, a month and a half in, but positive that you could use this in your analysis if you're analysing the effectiveness of fiscal policy on the issue, for example, now of inflation, okay? What this shows is that while there was a noticeable boost in income, there was no significant spike in spending over and above the normal month-to-month volatility. Now, as a result, right, what that also is highlighting is that, figures are going to be released soon, which will have the ABS's monthly inflation rate data, and it's expected to be the lowest level since 2021. Now, remember, monthly data is not as reliable, right? We've talked about in prior episodes that monthly data has a lot of noise, right? It's why generally the RBA use the trimmed mean, and they use that over quarterly periods to get a more accurate point. But either way, even factoring that in, I think this is some really positive news if the monthly figure will be at its lowest since 2021. And I think all of this highlights, therefore, that inflation is maybe going in the right direction. And the good news for the budget and fiscal policy is that it isn't potentially creating that inflationary pressure that was expected it would do. Now, moving on, the US economy has some data that shows it's in an unexpected slowdown, okay? It grew at its slowest pace in nearly 2 years, okay? So if we take a little bit of a look, okay, and dive in here, right? GDP increased 1.6% annualized last quarter. That's the slowest since the second quarter of 2022, okay? Now, note economists had sort of forecasted to be much higher, 2.4. Now, obviously there was a range, but clearly it's fallen below expectations. So there's still economic growth, but it's slowing, okay? Now, I think the point of this, right, is that the rate of growth here was below the US Central Bank's official regard as the non-inflationary growth rate of 1.8%, okay? And so I think broadly what this has highlighted is, okay, the US economy is surprisingly slowing, and that doesn't bear well for the global economy, right? Simply because, we've got, we've got inflationary pressures for sure, but we also want to maintain economic growth, low employment, strong labour market, etc. Now, what they're seeing flow on here, okay, is that this is having a bit of a flow on. It's early days yet into the labour market, but they are seeing some flow on into this labour market. And we can see this here in a follow-up in a Sydney Morning Herald article, which also highlights that, look, some data came through from the US, okay, and ultimately, this indicates there's probably going to be a rate cutting cycle in the US to deal with slowing growth, which, again, Australia, we take our cues from the globe around monetary policy. We've already seen, the US and the EU and Canada and New Zealand, for example, enter into a rate cutting cycle. And if anything, this is going to accelerate the global rate cutting cycle, which places more pressure on Australia as well to do so. Now, what they have identified, okay, is if we sort of make a little bit of a flip down, right, as they can see the first stage of the labour downturn in the US is clearly underway, right? Job offers are down, and we've seen that occur in Australia as well. This is not just a US phenomena, it is also certainly happening in Australia as well. Now, that's the first stage, okay? The second stage is then when people start to be laid off. Now, it doesn't look like that has yet emerged in the US, and it's certainly not in Australia, right? Although, unemployment rate did tick up slightly. In most cases, it wasn't because of that. It was because of, a rising participation rate, which was last week's episode. Now, I think the interesting thing here, though, is what is going to happen given if the US economy is slowing. Will there be other parts of the global economy that will pick up the growth? The Eurozone is in a deep manufacturing recession. It's tightening fiscal policy, okay? And China is sinking further and further, okay? And we can sort of see that from a Chinese perspective, right, ultimately, they're seeing, used home prices, as you can see here, dropped 14% from peak to trough. They've been falling almost every single month. So their property sector is in a world of pain. And the reason that's important for countries like Australia is that they use a lot of steel. And to produce that steel, they need a lot of iron ore. And so that is impacting their demand for iron ore globally, and therefore for Australia as well, the iron ore prices, but also demand for iron ore in our exports. Now note, if we take a look at this article here, which again, Sydney Morning Herald looks at the fact that China's struggling and what that's going to mean for Australia, okay? We can see that the price of iron ore, right, has collapsed to its lowest level since 2022, okay, having plunged more than 30% this year. And we can go and look at that, right? We can see, okay, and if we go to 5 years for a moment, okay, we can see that it's reached its lowest level since 2022, okay? And it's really been on a downward rip all of 2024. So we can see that it is going the wrong way in terms of the price. Now that impacts our terms of trade, okay? And it certainly impacts our trade balance in terms of export revenue that we're bringing through. Now, as this article highlights, most of this is a result of that floundering Chinese property market, okay? With the inability, of people to sell property and therefore many are left unfinished. Now, additionally, right, the Chinese government is reluctant, and this article highlights this, they're reluctant to sort of put a lot of stimulus into the Chinese economy because of rising debt, right, that they have already, they're already grappling with. And so it's not as though the Chinese government is going to use fiscal stimulus as a way to stimulate the Chinese economy, which will continue then to, produce demand for our exports and our commodities, okay? And so the challenge for us is that it does have major impacts because Australia exports more than 40% of our iron ore to China. So you can see here that Chinese economic growth plays really big ramifications for this. Now, note that the Treasurer did identify that it could, just that drop in the fall of the iron ore price, could wipe off over $3 billion from the federal budget, in terms of the revenue that they're getting. And that's because they make assumptions about what they think the iron ore price will be in the future, and they bake that into their projections for revenue. So $3 billion, it's a $710 billion budget, okay? $3 billion, is still a big hole. It's $3 billion, okay? And so there's still ultimately a really big hole there that we need to be really mindful of, okay? Now, note, I think at the end of the day, okay, what we can sort of see, right, is that, you've got China, they've got a shrinking population, okay, they've got slowing economic growth, okay, they grew at 4.7% annual growth in the June quarter, below the government's 5% target, okay, the Chinese government are really struggling to convince consumers to spend, okay, and so ultimately what they're trying to do, okay, is they're trying to ultimately, okay, use very much not like a big fiscal stimulus package, but they're ultimately trying to, okay, use more of like a doubling down on trying to export its way out of trouble, which this article here highlights, okay, where they're going to ultimately try to export more to generate more export revenue, to generate more economic growth in China, and they're going to use that rather than borrow money or use fiscal stimulus. But the implication for everyone else is there's going to be more and more cheap Chinese goods on the market, right? And it's going to raise those issues that you've looked at under protection and free trade around dumping. So there we have it. We've got, I think, a complex period of time coming through, given both the US economy and Chinese economy slowdowns, with some major ramifications for the Australian economy as well. Hope all of you who sat your trials got your results back and are really happy with your results. If you're not, we run a bounce back program for HSC Economics where in the next basically 8 or so weeks between now and your HSC exams, we do a comprehensive step-by-step review of the entire HSC Eco course, helping you really master the content and build those essays that you're going to need to really unlock improved marks I'll drop a link below as well. If you need some help, get in touch with us. It starts next week.